morning, everyone. Happy to be here with all of you this morning. I want to introduce you to our panelists. This is John Morris, who's founding partner and CEO of 17 Asset Management, Tarun Mehta, a partner at the Avishkar Group, Yasmin Saltuklami, the Deputy Chief Investment Officer at the CDC Group, and Lorenzo Bernasconi, who's Managing Director of Innovative Finance at the Rockefeller Foundation. Thank you all so much for being here today with all of us. So we're coming off of the UN General Assembly, and many of you, I think, were also probably at the Global Impact Investors Network conference as well. And I think that where we stand right now is that there's this understanding that as a world, we're not on track to achieve the SDGs. That, I think, was the key message really coming out of UNGA. And that there's currently not enough money being deployed to address some of these critical issues. So I wanted to start with a little bit of a stock taking. And so I wanted to ask each of you to share with us what you see as the greatest challenge that's holding back sort of this mobilization of additional finance towards the SDGs. Is it a lack of appropriate tools? Is it a wrong focus? Is it a lack of information? John, do you want to kick us off?
Sure. Thank you. Thanks, Devex, for this. I'm very optimistic. We are not on track. In order to get on track, though, I think we need to think more of ourselves as disruptors. And the development community, I think, needs to think of themselves as more as financial services industry. Talk to the asset owners about how products, which they think of as projects, should be designed for their interest. But I think we need to disrupt the capital markets more from the development community and the problems being the base of what investment products get designed around.
There's been a lot of capital that has been raised in the last couple of years under the name of impact and facilitating the SDGs. Most of the capital that's been raised is premised on two kind of theories. One is that all investments create impact, and two, investments in the space can deliver similar returns as more commercial investments that we have traditionally known. Now, therein lies the challenge, right? So we have taken a lot of strides in terms of kind of mobilizing capital, but we're still approaching investment in the space, in impact, in kind of delivery of SDGs, very similar to what we have been doing in more traditional asset classes, right? And that is where tools, innovative financing tools, are very helpful. But we really need to fundamentally think about how we approach the actual investment that will facilitate the implementation of the SDGs.
So from my perspective, I think a lot about how innovating for impact often comes with an assumption that you have to sacrifice rigor in some way. So you're going to step into a space where there maybe isn't yet a market. You're going to pioneer a new solution. You're going to work with a business model that's just developing its unit economics. You often have to take higher risk in order to work in that space. But how can you take higher risk without sacrificing rigor, I think, is a question that a lot of investors arrive at and probably step back from. So CDC, we've been working with a portfolio of catalytic capital where we've articulated, and we've just published last week with Impact Alpha, a quick read that describes how we do this. We've worked really hard to articulate how can we apply a higher risk appetite to those young markets that are either responding to persistent market failure or emerging trends. How can we work in those markets with a higher risk appetite without sacrificing any rigor? But that's been a journey. I joined CDC just over a year ago. It's taken quite some time to put the rigor around that. And I think most investors want to approach these challenges with rigor. And that element of time in order to arrive there is something that we don't have a lot of.
Well, let me start by thanking you for being here. It's a real pleasure. To your question, look, I'd say there's a number of factors as to why we're not quite there with bridging the SDG financing gap. And I'd start with, I think there's still a lack of political will. If you look at even just ODA numbers, right, we're about half of what we should be at, which is if everyone lived up to their commitments of 0.7 of GDP, we would be at 300 million, we're about 150 million. I think that's just indicative of where we are in terms of the actual political will that's behind this. And there's, I think, enormous amounts of opportunities, innovations that could happen on the policy front to making sure that we have the right kinds of incentives to driving the capital at scale. That aside, I'd say there's other two factors that come to mind. Where I sit, I see that there's still a big gap between what's happening in the development finance world and the impact investing world and the mainstream capital markets. And there's a need for us to bring these two worlds together and ultimately to activate the mainstream capital markets to driving capital towards impact. And I'll leave it at that problem set because we can go into what needs to happen to do that, and there's various things, and it's a complex question. And maybe where I sit from Rockefeller Foundation's perspective, part of what we're looking to do is to fill that gap of how is it we can more effectively bridge mainstream capital markets with the world of impact and that of development finance. But I'd say that, picking up on, Yasmin, what you were just saying, I think that there's also a need for us to develop more fit-for-purpose financing solutions. So you think about the history of the capital markets, it hasn't been designed to address the types of challenges that we have today. And we need to think about new ways in which we can, I think, leverage investment and finance to really finding ways in which we can effectively drive investment at scale towards areas of greatest need.
So I want to pick up on that because I think one of the critical questions is, do we currently have those tools? Or do we need more? Do we actually need more tools, more financial instruments to be able to get there? Is it about shifting the way people think about this? Is it about streamlining and scaling existing tools? Do we actually need more innovation in this space? Are we where we need to be?
Oh, well, I mean, my title is that of innovative finance, so obviously I'd argue
so you
absolutely,
hope so.
It's the future. Look, the way I think about it is what's stopping the money from flowing is ultimately market failures. Not all of it is an investable solution. There's a whole set of SDGs and global challenges that are not going to be investable, but there is a whole set of things that I think we haven't even started scratching the surface of what is possible. And if you look at the amount of innovation that has happened just in the last 2 to 3 years, around, say, blended finance. You can, I think, call that an innovation or not, but I think the point is, one way or another, we're going to need to find ways of making it possible for more mainstream finance to flow towards areas of need, and blended finance helps address that issue. In that you're addressing kind of core issues, whether that's on the risk or return, or indeed on the impact side of the equation, that means that capital isn't currently flowing. And so I'd say that we need to most definitely continue innovating. I think that there's space for greater standardization. And I think that there's a need for more institution building. And I don't mean by creating new institutions, but I mean more creating expertise that is going to allow us to do this more effectively. And nodes of greater coordination. That the fact is that this remains an incredibly disaggregated market, particularly around access to catalytic capital or concessional capital, and the transaction costs as a result of that are just far too high. So I think definitely we're not quite there yet. I think it's super exciting, and I'd say that what gives me hope is the amount of interest and talent, and indeed now interest from some of the more mainstream investors and asset managers to start taking this stuff seriously and recognizing that they need to innovate one way or another.
Yeah, and there is a kind of little bit of kind of hypocrisy in terms of the risk return. We have large swaths of capital in certain countries which are generating negative interest rates. And anything better than a negative interest rate is a positive interest rate. So, if you can deploy that capital in impact investments that facilitate SDGs and create real impact, and even if you're able to get a nominal interest rate or a rate of return, that's better than just sitting at, idly in a bank account where you have to pay the bank. So I think that, we need to mobilize capital by conveying, that there is recalibration of risk and return, right? And there is, as to Lorenzo's point, there has to be some level of standardization and consistency and discussion on what is it that we can do together. And we also need a lot more success stories. So for example, in the context of India, microfinance has been a huge success story where impact capital came in first, catalytic capital, and then that has been followed by mainstream commercial capital, and everyone has done well, both monetarily and from an impact perspective. So similar to those sectors, there are other sectors where there are huge success stories that need to be told to convince investors to come in.
Can I add one point here? I think I agree with the need for innovation, but I think there's a risk of over-architecture. And when in many years of working with institutional investors looking at an impact investment opportunity, what you soon realize is if you layer risk on risk on risk on risk on risk, right, people can take one step out of their comfort zone, they won't take 8. And so if you're talking about an innovative intervention, maybe use a plain vanilla structure. If you're innovating at the structure level, like green bonds, the end recipient of the finance is plain vanilla. So I think there's something about finding the right balance and not pushing investors too far all at once. Otherwise, they'll just stay at the starting line, I think.
Yeah, I also think that it's not about more tools. It's really looking at the process that people are undergoing. Wall Street was built on a linear process. Models over a certain industry has a certain value. But solving problems is a design thinking process. And that means you bring in multi-stakeholders around a problem. And I think the failure of the current situation is because the asset owners aren't being brought into the discussion at the origination period of the times products are created. And so they don't participate once they're figured out. The hard work that's being done on the ground, and especially in emerging markets where the risk is much lower than it was 10 years ago, is a shame that it is not larger size. And the reason it's not at larger size is because long-term private capital is not participating. The people that are participating is the development world, which really has a one-year funding cycle. And so there's a mismatch. So really taking a design thinking approach to what is the outcome of the problem we're trying to solve? What are the stakeholders to come in? The stakeholders also include the long-term asset owners.
Yeah. So Yasmin and Lorenzo, you both talked about sort of catalytic capital, and you represent a DFI and a philanthropic institution, and I think there's a specific role that organizations such as yourselves can play in this space. And I think one of the questions that a lot of people are asking is, are DFIs, are philanthropists taking enough risk? And so I wanted to ask you how you think about how you take risk with the money you're deploying, and whether you need to take more risk. And I know, Yasmin, this is something you guys are thinking a lot about, and your Catalyst portfolio is trying to do this. But maybe we can dig into that a little bit, because I think it's an important question to be asking about where different actors sort of fit in and what your role can be.
Yeah, great. So I've spent some time looking at the blended finance universe, and I thought a lot about what is the role of our catalytic capital within the universe of blended finance. And I kind of arrived at this realization that we are actually looking at the stage before blending often at CDC. So we obviously blend our capital with others. In a lot of our transactions, we have a whole funds business where that's probably the case in almost every investment we make. But with the catalytic capital, for example, we've created 2 wholly owned subsidiaries which are 100% catalytic capital. They're not blending. And actually, one of the, I think, differentiating features about how we use our catalytic capital is that we articulate that the ambition is about market shaping impact. And mobilization of commercial capital into that kind of space will be something we will look to achieve over time. So we're not necessarily looking on day one to bring in all that capital alongside us, because we're working in the space we recognize is risky enough that we need to put 100% catalytic capital, and we're willing to take that all on our own. So the two spaces where we've created those companies are volume guarantees for medical technologies, low-cost medical technologies to reach into low-income markets, and which is called Med Access, and a company called Gridworks, which is working to try and extend electricity grids on transmission and distribution across Africa. Those are really hard problems. I mean, you're talking about shifting the whole pharmaceutical manufacturing space with one, and public-private partnership in electricity grids in the other. Those are really tough problems, and we think that's exactly the kind of space where we should be working with catalytic capital. And it's not yet ready for commercial capital, but we'll look to bring those investors in the future.
So I guess one of the questions I have is, I think people on a whole have sometimes criticized the CDC for the level of return that you're seeking to get across the portfolio. And so as you're looking at catalytic capital, are you willing to make significantly lower returns? How are you thinking about the portfolio in general? Are you willing to, because I think if you're not willing to take the risk and actually accept lower returns, there may be sort of a mismatch.
So I come from a mathematical background, so I like to think in terms of probability distributions, which have two dimensions. So we never just think about return or just think about risk without the other in tandem. So the way I would describe it is, with a catalyst capital, we are looking always for a net positive return at the outset. I mean, it's really hard to tell an investor, please go and lose some money. Nobody wants to do that. And we're investing taxpayer money at the end of the day. I'm not being flippant. We look for a net positive return. But what we expect to see in the shape of that probability distribution of returns is that there will be a higher chance of loss. And so that means we're going in with an appetite to earn a return, but with an understanding that the range of potential outcomes of that return is wider, which means we might, on the whole portfolio, potentially lose more money. That means that we have had an arrangement with our shareholder to put in a different risk-return expectation on our capital that goes into this portfolio. But when we go into the market, we work really hard to go in at market terms and not distort anything at the market level.
Yeah, so our approach is a little different in that, maybe just take a step back before going into that. I think that a big challenge you have in the DFI world is that most DFIs, and CDC is an exception, are structured as banks. So they are constrained by the very basic structure that they have. And I think there was a great rationale for why they were structured that way, and maybe that's somewhat outdated. But at Rockefeller, so we also are keen advocates and have deployed catalytic capital. And for those that maybe are new to the term, basically that's just more risk tolerant, more patient capital. So we have real flexibility in the way in which we deploy those investment dollars. And within Rockefeller, we've got a portfolio which we call Zero Gap. And really the Zero Gap portfolio is focused on incubating new financing solutions. And it's got kind of two components to it. One is a grant component, and there it's super high risk. We have about 45 ideas in the portfolio. 90% of cases we're the first funder, and they're all first-of-a-kind solutions. And there really we're driving innovation, recognizing that's not the only solution that we need. Of course, we need to replicate successful solutions and scale, but there is always a need for innovation, and there's very, very little funding that's going towards that. So we try to fill that gap. And then we have a fund, which is the Zero Gap Fund, which we manage, and we've got the MacArthur Foundation as an LP in that fund as part of their commitment to the Catalytic Capital Consortium, and we're forever thankful for their partnership on this, which have been great thought partners on this. And there we look for kind of single-digit low returns. And the idea is to introduce some of the rigor, the investment rigor into the whole process, so that helps. But really, our goal is not to have a certain return. It's really to think about, first and foremost, the impact, and secondly, it's the leverage. And there we are willing to, if the case may be, we will be willing to lose, all of our investment, so long as there is the impact on the other side. And maybe just a very quick example on that. We recently did an investment with Leapfrog, which some of you may know about, their latest fund, which was about $800 million. And they had a challenge whereby there was a downside risk issue that kept a number of investors out of the fund. And what we did was we put in a $3 million investment into the fund. So we're a normal LP like anyone else. But on the back of our $3 million investment, Leapfrog took out an insurance policy, in which case, if this event were to occur, our $3 million would actually serve as a deductible. We would lose all of our money, but this was then enough for us to actually be able to leverage $300 million. So that's the kind of way in which we think about it. So, fingers crossed, we will make a healthy return as all other LPs in the fund. But if this were to happen, we would then, lose our investment. But we're okay taking, obviously, those kinds of risks.
And Tarun and John, I wanted to turn to you because you both raise and deploy capital. And so I'm curious, as you're out there doing this work, whether you think there are unrealistic expectations on returns, whether they don't match sort of what you need to be able to raise capital to address some of these critical development issues.
It's very refreshing to hear Lorenzo about the structure with Leapfrog, but I'm yet to meet an LP who didn't want it all. Huge impact, good returns, co-investments, side letters. It's par for the course. So I think things are changing. I don't think that the expectations are necessarily unrealistic, but there is that kind of higher, kind of burden of proof that can you really create impact and generate commensurate returns? And most of the companies that we invest in, they're early stage, where we are the first institutional investor, because that provides a catalyst for other commercial capital to come in. And we've always attracted commercial capital in the context of India, at least, given its size and scale. And I've got LPs sitting next to me who have kind of participated in that. So we do, but when you come into an early stage investment, it's not that your risk is high, but the gestation period for a monetizing event is longer, right? So it might take you 7, 8, 9 years. And we need more patient capital, right? Because yes, we can exit earlier, but that would be at the detriment of the company in terms of a monetizing event. They need some time to grow. The multiples tend to be higher, but yes, the IRR might be a little lower. So there has to be some give and take in terms of the kind of investments we do to create real impact.
Our first effort as a new company is in Jordan. And a lot of people ask, why are you started in Jordan as an asset management firm? Is there any interest? Will there be any interest for investors to do this? So after 20 design sessions later, after meeting with 750 people over 10 trips and a full team in Jordan, after having tables of either women or youth or refugees or business owners or politicians or industries, the understanding of the need and the opportunity to get a return, and that return to fix the problems of society as a social contract, matched with discussions with asset owners, allowed us to come up with a structure that fit the SDGs, SDG 5 and SDG 8, fit the return profile of investors, for-profit investors. 20% of it is a first loss facility that through the process, government kind of came to the table to provide. And a team we could hire on top of that that would be led by the carry of both financial return and an SDG return, 10% financial, 10% SDG-driven KPIs. The result is the dialogue with investors is a lot easier than I thought. And so the appetite is definitely there. There is not a problem of capital looking to invest in the SDGs. It's going back to a design process and getting the investors into the discussion as you begin the process.
And so I think we would be remiss if we didn't discuss one aspect of this, which is that, as we look at the world today and where it's going, the poorest people in the world are increasingly going to be concentrated in least developed countries and post-conflict countries. And these are environments where it is harder and riskier to make investments, particularly commercial investments. And so I wanted to ask you, how do you think about how we invest in those environments? Are there situations, Lorenzo, you said that there are some problems that are not investable. So I think it's important to have a frank conversation about what is investable, where can we mobilize commercial capital into a market, and where maybe it needs to be, 100% catalytic capital at the start. So how do we really look at the investment climate in LDCs, in post-conflict countries, and think about how we start to mobilize capital into those areas more effectively?
Well, I'm an advocate of Jim Kim's idea of the cascade, which is the idea that currently, if you look at the way in which development finance happens, it's rather inefficient. So ODA, which is official development assistance, is about $150 billion, and a large proportion of that is actually going towards financing of infrastructure. These are grants in the least developed countries, and I think that there is need for us to, have a more efficient sort of division of labor, where a lot of the development finance institutions, the development banks, should be going into these markets with their availability to finance this through kind of lower cost capital, and where they're best positioned really to be taking that kind of risk and have the experience and the kind of political cover that you need to be able to do that effectively. And ODA should go towards that which you cannot finance through an investment, of which there's a massive need, needless to say. So I'd say that's one core component of it. Just more generally, I would say that, it gets back to the proof point question, and I think that there are angles and there are, pockets of opportunity that we really need to explode and bring to the surface, and where there's opportunities that we see things that work and are scalable. I think that we need to find ways in which we kind of congregate together, and I talk about me and my colleagues in the philanthropic world, to see how is it we can move towards scaling those solutions.
So one of the things we think about is how can we be market shaping in a particular place? So that usually would involve a portfolio of interventions. And for us, I think Myanmar is a really good example. So we have invested in 3 funds that are working in Myanmar. We have a direct investment through one of the companies that one of those funds is in. So we followed on directly into one of those companies as it's growing, really exciting, distributing Wi-Fi, internet access, and affordable internet access across Myanmar. And then we have a portfolio of technical assistance and market shaping grants through a facility that we call CDC Plus, which sits alongside of those investments and works to build out, for example, some of the gaps that we've identified through the investments. So one of the things we recognized across those fund managers was there's a need for talent. The fund managers at the GP, but also at their companies, right? So that's a natural space for us to bring in that grant capital alongside and build out a program to support talent in the industry. And then because those are venture funds, we thought, well, what about a venture capital network to build some of that field building work that supports them on the whole? So we think about this as kind of a clustering of investments, and then where reasonable to bring in the technical assistance as well. And that together can start to have a market shaping impact on at least one piece. We're not going to solve everything, and I completely echo what Lorenzo said. There's definitely a space where investment's not appropriate. But for us, if we can take a targeted approach and say, okay, let's think about the young businesses and building out the venture capital and private equity ecosystem, that's where we can bring some of our expertise to bear, and there's a growing kind of burgeoning little wave of energy to support, then that works, I think, really well for us.
And I think one of the questions then is, at what point have you sort of done that field and market building work, right? CDC has invested a lot in India, has really helped to catalyze the private equity space there, but I think there is a critical question of when do you say, okay, this industry is now sort of able to attract commercial capital, and we're going to step back from that market and go to another market where maybe we can help build the space up as well. Obviously, there's not a lot of Indias out there with this market size, et cetera, but I think that's an important question. I'm curious how CDC is looking at that.
I'll share some thoughts, and then I'm interested in Tarun's view on that too, actually. So I think one of the things, when we think about the success factors for our catalytic capital, there is this element of graduating from dependence on it that we would see as a success. But there are also circumstances in which you just shift where the catalytic capital is focused. And so India is obviously a significant country. There's lots of variation in terms of the life people are living there, the states, the economic situations across states. So one of the things we think about is how do we shift the way in which we're working in the country so that we can shift the catalytic capital, but also our growth capital to the place that needs it most. And so that's always an active discussion. I don't think we take it for granted that we should just step back. I think there's always more need, but you have to shift. Tarun?
Yeah, so we have always put the entrepreneur at the center of everything we do in terms of investment, right? Because these are entrepreneurs that are creating solutions for scalable businesses that solve very large problems, right? And taking an entrepreneurship approach to it, right? And we've done it with partners like CDC in the context of India. And it's much easier to scale in India. And commercial investors want to see scale, right? That's the name of the game. Now, we have done that in sectors as diverse as waste or logistics or transport, and impact, and have created impact and kind of addressed a multiple of the SDGs. Now, in countries outside of India, the scalability, the ability of a company to kind of ramp up and become a successful enterprise in a reasonable period of time is slightly more challenged, and that is where actually the catalytic capital is actually most required. So countries like Myanmar, as Yasmin just said, that's a great example of a country which needs that kind of capital. Whereas what a country like India needs is perhaps now the more commercial, long-term, capital that can kind of, drive enterprise to scale. Yeah.
Great. We have time to take a couple quick questions. So if people have a question, want to raise their hand, I can call on a few of you. It's kind of hard to see out there. All right, we'll go right here. And if you can introduce yourself, tell us your name, and then ask a question quickly so we can get to a few questions.
Hi, I'm Jones. I'm from the Make My Money Matter campaign. I'm interested to probe your assertion, John, that we need to get asset owners in at an earlier stage, and long-term asset owners as well. And by that, I would assume you mean pension funds, but correct me. Okay. So obviously, we know that the rules around how pension funds invest often discourage them from this area. So we sort of have a conflict there. How do you think that we deal with that conflict?
Do we have any other questions? Because I could take, there's one back there.
Hi, thanks. Jesse Griffiths from ODI. Just a question about the level of analysis and thinking about this. There's a lot of talk about the projects and the firms and also the markets, but what about, I think the main way we should look at this issue is from the economy perspective. So it's not just about finding the right investments, but how does it fit within the overall strategic development of a particular economy and the development of the financial sector in that economy. And I wonder if you have something to say about that.
Great. And then I think we'll take one more right here, and then we'll go to you guys.
Hello everyone, I'm Gaurav. I just came from India yesterday, and I'm so happy that India is such an important place for discussion here. I am into the solar home lighting system, and I've installed solar home lights in very rural parts of India, in about 300,000 homes in 17 states. So I just wanted to say that I'm very happy about that and very passionate, and I want to put electricity and connectivity to most of the places. I was just very happy to hear there's so much more important about talk about India.
All right, thanks. All right, do you want to go
Sure.
ahead?
The dialogue does not mean there's a commitment at the time of the dialogue. And the dialogue also is not just for pension funds in the UK, but for pension funds in Sweden and pension funds in the US. What is their appetite? What is their interest long term? And if there is a particular fund or investment into a location, what is the structure that's appropriate? What is the long-term return profile they're looking for? And then if they achieve that profile, will they continue to be investors in the next fund and the next fund? Is this something, talking about market building? We see Jordan as just a first fund to crowd in investments. So we want to talk to everyone about it, because then there'll be a second one and a third one. It's not about getting 100 million into a place that OECD countries are all supporting for the last 10 years. It's about getting $250 million and a lot of other pools of capital coming in and reinvesting private investors into Jordan. And we're starting the process in Mexico, and we're looking at Ethiopia. And these are things that are not a one-off fund. It's the beginning of a dialogue. So the engagement of long-term capital is entirely necessary for us to put the right people in place. So the people we put in place in Jordan was a response to the feedback we got from institutional investors, insurance and pension funds in Europe. The Luxembourg structure was a response. It wasn't from anything we learned on the ground. It wasn't anything we learned in New York. It was from the discussions we had during the year of developing this. So that's why it's so important to have these.
Just comment on that as well. I think it's an excellent question and a really good point. One way in which we look to address this, and kind of a second pillar of our strategy, is that we're partnering with leading asset managers who have experience, obviously managing the money of asset owners. And so the idea here is, there is this interest now moving deeper into the impact space. And so we as a philanthropic institution have both an experience in impact investing, but also programmatic expertise in certain areas that we work in. We're looking at how can we translate that into an investable opportunity that can really bring in large-scale mainstream investors. And so we started this in the infrastructure space. As a foundation, urban resilience has been a core focus of ours. We've invested about $500 million over 10 years. And so what we've done is we've created an investment screen and also a governance structure in partnership with a leading asset manager to create a new fund focused on urban resilience that has a really deep impact, it's a blended fund. So the idea here is that we're bringing that investor or that asset owner, or asset manager rather, into newer areas, kind of deepening the impact that they're having and really trying to create, so to speak, a new asset class. And so I think that needs to happen more. Those are kind of the new types of partnerships where you bring people on the ground who've got the expertise working alongside asset managers that have the track record, have the experience, that can bring the credibility that we need to bring in that investment at scale.
And does someone want to take Jesse's question on sort of the level of analysis? Yes, Dana?
Yeah, I can speak to that. So we spoke a little bit about the work in Myanmar to think about building out the ecosystem for venture capital and private equity. And that, to me, is part of that question about, you said, how do you build out the financial services to support the broader economic development? That's kind of a pretty targeted example. The other side of the story is maybe to the point on our investments in India. So that's where I would agree with you. We're not really using the catalytic capital end of our work. We're thinking more about how our growth capital can then pass the baton on to others in investment capital. And we use a word called mobilization to think pretty actively about how do we bring in institutional investment to look at a space that's ready for it. And so to us, at least as an investor, that's a clear way where we can think about that broader ecosystem for economic development. And then, of course, we're always working right alongside DFID and others to think about the space where it's not investment intervention, but we can share what we've seen or observed or needs that we've identified and kind of make sure that we're integrated across, at least that's the ideal, that we're integrated across these partners working in the same places.
And maybe just to add one thing which we do from our perspective is that there's certain types of investments that we've seen where government support is absolutely critical. And in those cases, that's where we seek it. We make sure that that's in place. In other cases, frankly, the investment can happen because for various reasons, the connection is less strong. But where we think that either from an impact perspective or from just a financial viability perspective, the government support is key. That's part of the due diligence, and if it's and in cases where we can, we support our investees or grantees in making sure that they get that support.
Great.
If I can just add one thing. So, there are, I think in particular, financial inclusion as a sector has seen a lot of capital, and it has scaled up pretty quickly. And that's really been the poster boy for success. But I think we need to encourage, and we need government involvement, we need more catalytic capital in some of the other sectors, right? So if you look at even the amount of money that goes to the SDGs, the 13, which I think is climate, has received a disproportionate amount of capital because there is global consensus, there is willingness of everyone to kind of work towards that. And also there is the ability to deploy large amounts of capital, which is important for commercial investors. So we need to kind of put all of that in context when we look at which sectors to invest in a particular economy.
I can't wait until we actually have figures about catalytic capital and blended finance on what market and what industry within those markets needs a certain percentage of catalytic capital to draw in market rate returns from long-term investors. And I think that time will come sooner if we all collectively think about asking those questions. When you come into a fund or you come into an investment, say, if you succeed, if you hit your benchmarks of return, what will that lead to for the next investment 5 years from now or 2 years from now? And if each investment is leading to less and less need for catalytic capital, it's a win for our taxpayers, it's a win for our development efforts, it's a win for society. And so catalytic capital is necessary, and we should be very excited about how it crowds in private investment. We should never worry about, someone's going to make a return on that other money. We should say, great, celebrate it. And then the next one is how we reduce it. And everyone wins in that process.
Great. Well, thank you all for kicking off our day with a great conversation. We'll be digging into a lot of these themes throughout the day. So please join me in thanking our panelists.